Let's get started with the first conversation of the day, and it has to do with passive investing in equity. It is something that has gathered ground, that has gathered pace over the last decade or so, particularly here in India and towards the latter half of the decade, in fact. But why is that? Let's introduce the guest for the day. We've got Santosh Navlani, Chief Operating Officer of ET Money. Thanks so much, Santosh, as always, for taking the time. Let's start with what it is. For those that are not familiar with the concept, what is passive investing in equity and why is it that it has been gaining traction?
So, Alex, when you choose to not manage money in an active manner by taking stock-specific calls or sector-basis approach to investing, or having a view towards any specific kind of market cap being better suited for future investments, is when you tend to become more passive towards the approach. And that means you're not managing your money actively. So when you choose to not manage your money actively is where it becomes passive investments approach to investments in life. And India has a lot of innovations happening in the space where a lot of options are coming where people can choose to opt for passive investing approach versus active management, and which is gaining traction a lot. One of the primary difference, if I can kind of make it easier for people to understand, is in a fund, typically people have been used to buying actively managed mutual funds in large cap, mid cap, small cap, multi cap, flexi cap space. What happens there is, if the fund manager does bottom up stock picking approach, takes sector specific calls or market cap specific bets, or kind of has his own understanding of markets or earnings visibility of certain companies, and makes a specific portfolio construction and tries to outperform a benchmark, say Nifty 50 or Nifty 100 or a broader index like Nifty 500. Contrary to this, when you say it's a passive investment approach, you basically try to mirror the index performance on the upside as well as on downside. What happens there is you basically just buy the same set of stocks as the index has in the same proportion, in the same percentage, in the same weight, and maintain that weight on a daily basis. What happens is you mirror the performance of the index. And these two are completely separate approaches to investments in India right now.
So very well put. In a sense, you're betting on the growth story of the country, right? So if you're in an ongoing basis, I've met so many people, Santosh, who say, "Aaj Nifty upar hai," or "Aaj Nifty niche hai." You're not talking about the stock market as a whole. You're talking about a benchmark that has 50 stocks. It's in a sense representative of a portion of the market, not at all the entire market, but you're betting on the growth story of India, right? If you're investing in these benchmarks.
Yeah, of course. By definition, when you're investing your money in equity markets, you are betting on the economy doing well, Alex. That goes always with investments in life. But just to kind of understand, so typically people associate Nifty with Bazaar, right? Nifty or Sensex with Bazaar. I typically say, what is the market? And the answer expected is Nifty, where Nifty went. So that's a basically broad way to look at markets, but markets are far more deeper and broader in India compared to what it used to be. And as you said in the beginning of the show today, that Nifty kind of went down, but broader markets ended flat. So it's not always the correct picture of the market, though it is. If Nifty is not doing well for long, that means the broader market will soon start to follow soon, and Nifty starts doing well, the broader markets will start to follow soon as well. So the direction will always be dictated by Nifty, but not necessarily always. And that's where fund management comes into picture, where you say that I would not always put all my money in large cap. I would probably put my money in a flexi cap fund or a broader market index like Nifty 500, or a mid cap index, or buy a mid cap and small cap fund. So it is not always true, but yes, when you're investing, you're basically betting on the economy, and one of the best ways to take exposure economy is a broader index fund or a Nifty 50 index fund in that case.
To how we can use this in just a bit, but the broad types, Santosh, of how you can choose passive investing, essentially ETFs and index funds. How would you explain this?
So there are essentially two, every index fund, for that matter, basically would have two possible ways to invest in them. One can be a pure mutual fund, which basically we are all familiar with. Another can be an ETF. So a mutual fund declares its NAV on the end of day basis every day, and so does index fund does. So when you basically buy index fund in the form of a mutual fund, you basically are going to get the price at the end of day's NAV, or your units will be basically allotted to you based on the end of day NAV. But when you choose to say that I actually would want to actively kind of make an entry in the market when market is probably opening up a gap up or a gap down, or has basically going up and down during the day, and you want to take advantage of that price movement, the same index fund can be offered in the form of an exchange traded fund. So it's almost trades like a stock, like a share, just that it is basically a kind of, at the back end, when you look at a unit of ETF, it actually has 50 stocks of Nifty 50 in a proportion of the unit in that sense. So you can basically invest in index fund via two routes. One is a mutual fund, another is an ETF. And both are kind of gaining traction in the marketplace today.
Absolutely. Let's talk about some of these benefits associated with investing into these passive strategy funds. Clearly, and I think this is spoken about a lot, Santosh, one that stands out, of course, is the fact that they're less costly than the other actively managed funds. And in a previous episode, we've spoken about how this total expense ratio works. In a sense, you're not paying for the active management of the fund, so therefore it's cheaper. But there's more than just that, right?
Yeah, of course, multiple things. One of the biggest, so a lot of advantages which come to index funds, Alex, they actually flow from the number one advantage of index fund, which is low cost. So because, typically in investment management, the trading cost, the expenses that you run in brokerages and other areas, and the payroll or the kind of salary of the fund manager is the biggest cost in the whole thing. And when you take some of these costs out, you basically can actually enhance the return and pass on that return in the form of the cost saving in the form of a return to the customer or the investor, as we see in direct and regular as well. So whatever cost you save, you pass on in the form of return to the customer. That's what the essentially whole thing is. Now, why the cost is less? The cost is less broadly because of two things. One is there is no active role of a fund manager when you are buying or investing in an index fund. So when you don't have a fund manager, you don't support that person or the department with a lot of research or research reports or a different kind of analyst or a lot of other stuff which comes along with fund management actively. So that goes out and it saves you cost. And because of that, the other advantage comes in the form is the fund manager biases go down or goes to zero in that sense. Every fund manager will be managed money. He or she would have his own view towards markets, view towards understanding companies' balance sheets, view towards the macro picture of the economy, view on the interest rates, view on the market caps like large cap, mid cap, small cap doing better or worse, or something doing better than other. So that view will basically dictate how I as a fund manager take stock specific calls or position sizing of my bets. So that will ultimately result into extra returns or underperformance with respect to the benchmark. So that bias goes out. The dependency of fund manager itself goes out, because sometimes what happens is one sees a better performance because of fund manager, and you end up investing in that fund because of the fund manager, and the fund manager moves from that company. Then typically your entire investment in that fund becomes up for question mark, whether you should be continuing in that fund because fund manager is no more there, or you would want to stick around because you would believe that the fund management team at the AMC is pretty good and I would continue investing my money. So the two things which a fund manager bias and the fund manager's own dependence goes out the window. The low cost we talked about. Third aspect is basically, which we are seeing a lot more happening in the marketplace today, is better performance coming in from the passive funds or index funds. So if you look at data, the large cap space actually has seen over last 3, 5, 7 years almost 75 to 95% of the actively managed large cap funds have failed to outperform the benchmark, which is Nifty 50 or Nifty 100 in some cases. And when you are not able to beat the benchmark, then that means you're not able to justify the kind of cost that you are charging. And one of the ways to basically reduce that performance gap that you would have is go towards passive funds, which actually charge you far, far lesser. So an actively managed fund will probably charge you like a 40 to 60 to 80 basis points in direct plan, and maybe like 1.5 to 2% in a regular plan. Similarly, an index fund basically will cost you just 10 basis points on an average for a large cap mutual fund. So that extra kind of cost savings directly comes in the form of returns to you. So large cap fund has actively managed large cap funds have actually failed to outperform the benchmark. We are seeing for last many years now that is happening in mid cap space as well, where almost 50 to 70% of the mid cap funds which are actively managed are not beating the mid cap 150 index, which is the benchmark for mid cap funds. So what is happening is because of cost savings and markets becoming more broader, markets becoming more deeper, information asymmetry reducing in the marketplace, that is basically making an equal footing for everybody, and index funds actually becoming a better bet for you to continue putting money in for large cap and mid cap allocations. Small cap, we are yet to see this, kind of large deviation of outperformance, underperformance yet to play out with respect to index and active. But yeah, if one has a long view, then one can easily say that this probably is going to filter down into small cap space as well. So what is the problem for investors? The problem for investors is, how do I know a future winner when 75% of large cap funds have failed to beat the benchmark, 50 to 75% of the mid cap funds have failed to beat the benchmark? I wouldn't know who's the future winner. So I'm far more better off by basically sticking to an index or a passive way to put my money in.
Absolutely. And specifically on the large cap side, Santosh, on a net cost basis, definitely a lot of these passive strategies would be superior. But how does one use this? So you've said that there are clear advantages to having a passive strategy when you're talking about the large cap allocation in your portfolio. Would you say, therefore, that it's a good idea to have the core of your portfolio as a passive strategy and utilize the benefits associated with them?
So I think it's to each his own, Alex. But at ET Money, we believe that there is enough data available of the past that even if one believes that one has found a good fund today in the large cap space or a mid cap space for that matter, and one can invest one's money there. But the fact is, you invest for the future. And because you don't know whether the same fund will outperform the benchmark or be the top quartile fund in the marketplace or not, we are biased towards recommending investors to actually build a passive only portfolio, or largely a passive portfolio. There is one more advantage to that piece, not just the aspect of who is the future winner, but also about index funds are the only funds which give you what you wanted. So, for example, if I'm saying that I want to invest in a mid-cap index fund, or I want to have a mid-cap exposure to my portfolio, the actively managed fund, as per SEBI regulations, has to invest only at least 65% in mid-cap. The rest 35% can be in mid-cap, can be in small cap, can be in large cap, or can be a mix of all three. So what is happening is, you as an investor are constructing a portfolio for the future, thinking that you want, for example, 30% allocation to mid-cap space. And what is happening by buying a mid-cap fund in reality, an actively managed mid-cap fund reality, that you're only getting like 65 to 70% in mid-cap, the rest is coming in large cap and small cap. That means my portfolio construction approach is going for a toss. So for this second reason as well, we prefer sticking to index-based investments rather than actually going towards active side.
Okay, I think we've covered all of the bases, and we're going to speak about the next topic, I think, which will be quite interesting, which will have to do with flexi-cap, multi-cap, and how these work and how they fit into the portfolio. Thank you so much, Santosh, for taking the time. Always a pleasure.
Sure, thanks.